In this video, we are going to look at the part B of Accounting WAEC. In the previous video, we looked at the OBJ, the objectives of accounting. It has 50 multiple choice questions where students will be allowed to choose between 4 options. And then we were able to explain how students can maximize or effectively use their time to answer these 50 questions within the time stipulated. But in this particular video, we are going to take time to look at the theory part. Now, I mentioned in our previous video that accounting is divided into 3 parts. It's divided into 2 parts. The objective part and the theory part. Meanwhile, the theory part is divided into section A and section B. In section A, you are given 4 questions to answer 2, and then in section B, you are given 5 questions to answer 3. So in section A, you are expected to answer 2 theory questions and then 3 accounting questions. When I say accounting practice, where you'll be asked to prepare account. So in all, you are going to answer 5 questions, 2 from section A and then 2 and 3 from section B. So in this video, we are going to look at the section A of the part of the theory part of the accounting questions. Now in section A, we have 4 questions. 4 questions to answer 2, but I'm going to explain the 4 questions. I'm going to point out some of the emphasis of WAEC on these questions. So as a student, you take your time to look at the way these questions are answered so that it will serve as a guide for your preparations for the WAEC examinations. Now, question 1, it said, what are incomplete records? You can see there, that statement is not a singular. It says, what are incomplete records? First of all, when you hear the word incomplete, it means that the records are not complete. Records that are not, that certain fundamental information are actually hidden or is hidden, or certain fundamental informations are not there. When you see that a record is not complete, there are some fundamental information that you cannot find in that record. That is why they call it incomplete record. Now, bringing it to the palace of accounting, incomplete record is talking about any record that does not follow the double entry bookkeeping principle. In other words, any record that does not observe the debiting and the crediting of the receiver and the giver is termed to be incomplete. Another word for incomplete record is what we call single entry. That is to say that the transactions does not follow the dual aspect of accounting. Remember our principle, our double entry principle states that for every debit entry, there must be a corresponding credit entry. So any entry that does not conform to this debiting and crediting, it can be seen to be incomplete, or it can be seen as single entry. So if you are asked, what are incomplete records? Simply put, incomplete records are records that does not conform to the double entry bookkeeping system. That is it. And then let's look at the B part. They said, outline 3 limitations of keeping incomplete record. Let's explain what limitation is, because these terminologies are terminologies that students usually find it difficult to understand. When you talk about limitation, we are talking about the challenges, or we are talking about the disadvantages. What are those challenges? What are those disadvantages? What are those impediments that someone can encounter if you are practicing incomplete record? If the organization is not keeping double entry principle, if they are not applying this principle in their record keeping, what are the dangers? What are the challenges? what are the impediments or what are the limitations? Number one, we said the business cannot extract a trial balance to check the arithmetical accuracy of the ledger entry. Number one limitation is that if a business is keeping incomplete record, it will be difficult to extract trial balance. You know, trial balance is a list of balances extracted from the ledger to test the arithmetical accuracy of the ledger entry. The ledger is I call it the book of books, the principal book of account, where transactions are recorded, where every other transactions are recorded in a classified form. So when you keep incomplete record, because this record does not conform to the debit and the credit entry of accounting, it will be difficult to extract the ledger or the trial balance. Number two, the accuracy of any account cannot be verified. Every account that is prepared is expected to be verified. So when you prepare your record, when your records are not complete, it will be difficult to verify this account. The account you are preparing, it is not based on double entry bookkeeping. It will be difficult. Like for instance, if I want to prepare cash book, assume I want to prepare cash book, and then as I'm preparing the cash book, this cash book is prepared based on incomplete records. Now in the cash book, maybe you are not giving drawings. In the cash book, you are not giving capital. Or let's take it for instance, you are giving some statement, like you have you are giving non-current assets, you are giving values for current assets, you are giving values for liabilities, and you are not giving capital, you are not giving drawings, you are not giving capital basically and drawings, and you are asked to determine profits. It will be difficult, because the profit is a function of the opening capital and the closing capital. But if you are not giving these values, it will be difficult for you to ascertain the profit. So incomplete record will make it difficult for you to verify account that has been prepared. Now, another thing is that accounts are actually prepared for decision making. We prepare account for decision making. So when records are not complete, it's going to impede or it's going to compromise with the decision. Because when decisions are going to be made, they are going to be based on the record prepared. So when these records are not complete enough, then it will be difficult to take decision. The fourth one is that cost control will be difficult. You know, what we mean by cost control is we want to ascertain the cost breakdown, or we call it the breakdown of cost of production. If it is in a manufacturing company, we have classes of cost. We have what we call direct cost. We have what we call indirect cost. We have what we call variable cost. We have what we call fixed cost. All of these costs, put them together, constitute what we call the costing of a business. So, but if these records are not complete, it will be difficult to ascertain exactly the cost breakdown or the cost computation of the business. And then the fifth one is that it can lead to collapse of the business. If the progress of the business cannot be ascertained because the records are not complete, then what is the fate of the business? What the guarantee that the management of the business will be able to know that, okay, we are making progress or we are not making progress? So since records are not complete, the business can collapse. Because what will help management to come up with strategies that can help the business to move forward is when they've been able to ascertain the progress or the failure of the business. So, but when the incomplete record does not afford or does not give us that opportunity to know if we are making progress or not, then the business can actually collapse. And then the last but not the least is that fraud can be easily committed. It can be very easy and simple to commit fraud. Because one of the things that can really help a business to kick against fraud is when we have an account that is verifiable. When an account cannot be verified, then fraud can easily be what? Committed. So I have mentioned 6. They say you should mention just 3 limitations. I have been able to explain 6. Students who shouldn't be hard on themselves when they are looking at this video or when you are attempting to answer accounting questions. Sometimes you are asked to answer 3. But why I have to give you 6, so you have a pool of information that can serve as a guide to your answer. Let's look at C. It says, state 3 reasons a business keep incomplete record. We have seen that incomplete record is any record that does not conform to the double entry bookkeeping system. Now, what will now make an organization, having seen the relevance or having seen the importance of double entry principle, what will make an organization not to observe this double entry principle? Number 1, lack of resources. If the business does not have the necessary resources to maintain double entry principle, they may want to fall back to incomplete records or what we call single entry. They may want to do that because it takes money to be able to maintain double entry principle book of account. If you don't have the necessary resources, it will be difficult. So one of the reasons is what we call lack of resources. Number 1 is lack of awareness. Some businesses don't even know that it is necessary to observe the double entry bookkeeping system. Some are in chronic ignorance. Some people just move into business. They just want to go into business. They've not taken time to review the accounting system. So lack of awareness of the relevance of double entry principle can also make business to keep incomplete record. And then the third one is that it is less cumbersome. You know, some people say double entry is labor intensive. It is very stressful. So they just want to do something that will make it very easy and simple. They don't want to follow double entry principle because they feel that double entry principle is very, very cumbersome. So because incomplete record or single entry is less cumbersome, they may want to apply it. Then the fourth reason is lack of qualified accounting personnel. When you employ accountants that are not efficient and effective, or accountants that are not certified, accountants that are not qualified, the result will look like incomplete record because a qualified and efficient and effective accountant knows that for every account you prepare, you're expected to prepare it based on double entry accounting principle. But when these accounting personnel are not qualified enough, then it is possible that you can have a single entry. And then the fifth one is that when there is no legal obligation in a part of the business to maintain proper accounting record, when there is no legal obligation, some businesses does not have a very strong legal system that can determine their operation. They just move into business, so there is no check and balance. By right, there's supposed to have been a very strong legal obligations that will spell out the accounting practice that is expected to be adopted in a particular business. So when there is no system like that, then anything goes. Anybody can wake up and begin to prepare incomplete record. So I have mentioned that the first reason is when there is no resources, there is not enough resources. The second reason is when there is lack of awareness. The third reason is when we lack qualified accounting personnel. And then the fourth one is that when we feel that this incomplete record is less cumbersome. And then the fifth one is if there is no legal obligation. Now, let's look at question 2. It said question 2, it said identify the error in the following transaction and state if they will affect the agreement of the trial balance total. Identify the errors in the following transaction and states if they will affect the agreement of the trial balance total. There are certain things, terminologies I need to explain before we look at the question. First of all, what is an error? An error in this context is called accounting error. Errors are mistake that is made during the preparation of account. When you make a mistake in the preparation of account, such a mistake is called an error. And basically, we have two categories or two classes of error. We have errors that will affect the total of the trial balance and error that will not affect the total of the trial balance. Remember, I have said earlier that the trial balance is a list of balances extracted from the ledger to test the arithmetical accuracy of the ledger. The trial balance is what is used to carry out an accounting X-ray. You carry out an accounting X-ray on the ledger to see if there are errors. Now, there are errors that can affect the total of the trial balance, and there are errors that may not affect the total of the trial balance. Now, the errors that will affect the total of the trial balance is corrected through what we call the journals. We use journals to correct errors that will not affect the total of the trial balance, and then we use the suspense account to correct errors that will affect the total of the trial balance. Now, in this question, they said you should identify errors in the following transaction and state if they will affect the total of the trial balance. Number one, he said purchase of consumable posted to the purchases account. Now, when you go to the market to buy any item, as you go to the market to buy any item, two things are involved. If you buy the item by cash, two accounts will be affected. The purchase account will be affected and the cash book will be affected. So what you are expected to do is to post the transaction. You are going to debit purchase and you are going to credit cash, because the money that you are going to spend is coming out of cash. Because so since cash is given, you are going to credit cash and then you are going to debit purchase. Now, they have said that purchase of consumable has been posted to purchases account. Now, we have in the classes of errors that will not affect the total of the trial balance. They are called error of principle, error of commission, error of omission, error compensating error, error of transposition, and complete reversal. Now, in this question, for this particular error that is committed here, this error is called error of principle. Now, error of principle is committed when the wrong classes of accounts are involved. When the wrong classes of accounts are what? Involved. So, for this purchase of consumable posted to the purchases account instead of the consumable account, then that error of principle has been committed. Now, number two, an invoice amount incorrectly posted to the purchases day book. An invoice amount incorrectly posted to the purchases day book. Whenever transactions are posted incorrectly to the day book, such an error is called error of original entry. Error of original entry is committed when a wrong amount is posted to the account. Every amount that is involved in a transaction is supposed to be correctly posted to the account. So when the figure that is involved is incorrectly posted to the necessary account, such an error is called error of original entry. Now, return outwards posted to the personal account only. Now, this is where I'm going to spend some time to explain this. Return outwards. What is return outwards? Return outwards has to do with goods returned back to your supplier. You have gone to buy some items, and then taking the items to the destination of your business, you discover that some parts of the items did not meet up to standard, or some of the items are substandard in nature, or they have some faults. Such an item cannot be sold in your business. You have to send it back to the supplier. So when these items are sent back to the supplier, that process is what we call return outwards. Now they said return outwards posted to the personal account only. It has been posted to the personal account of the individual. Meanwhile, the corresponding entry is supposed to be in the return outwards. So when you are supposed to debit the personal account of the supplier because he's receiving the goods from you, and then you are supposed to credit the return outwards account. Meanwhile, it was posted to only one account. So this is what we call one-sided omission. This kind of error is called one-sided omission, or we call it error of single entry, or we call it partial omission. Error of single entry, error of partial omission, or error of one-sided omission. And this error will affect the total of the trial balance. So this particular error will affect the total of the trial balance. Why? Because you have posted to one side of the account and one side of the account is not affected. The total sales of 120,000 was recorded as 102,000. This is what we call undercasting. This is what we call undercasting error. Now, for every time you have this error of undercasting, it will definitely affect the total of the trial balance. If the trial balance, let's assume the debit side of the trial balance is supposed to be, let's assume it's supposed to be 500,000. The credit side is expected to be 500,000 as well. So anything that makes the transaction on the debit side to reduce by any amount, it will affect the credit side. So the sales, which is supposed to be 120,000, was recorded as 102. That is to say that there is an undercast. Now, I tell students that when you talk about accounting, what we call counting in accounting is called casting. So when you see undercast, don't ask yourself, what are we talking about? Are we actually talking about adding, mixing concrete with cement, like what they do in production company, what they call casting of a particular floor? This is not that kind of casting. In accounting, casting has to do with counting. So when a figure that is supposed to be counted is undercounted, then we call it undercasting. If the figure is above the necessary figure, it's called overcast or overcasting. So in this particular instance, they said the total sales of 120,000 was recorded as 102,000. That's an undercast. So in this case, this error will affect the total of the trial balance. Payment of check to Ike entered on the receipt side of the cash book and credited to Ike's account. Look at this. Payment of check to Ige entered on the receipt side of the cash book and credited to Ige's account. First of all, when you make payment to Ige, there are two accounts that should be affected. A payment of check to Ige. Let's stop there. A payment of check to Ige. You know that when you are making payment to Ige, Ige is receiving, and then that money is coming from somewhere. They say it is check. So by right, this transaction is supposed to be debited to Ige's account and then credited to bank. Whenever you are making transaction and you see check, it is only the banking institution that have the license to transact business with check. So anytime you see check in a transaction, check always represents bank. Now, they said payment was made to Ige, and this payment was made by check. So Ige is supposed to be debited because he is the one receiving the payment, and then bank is supposed to be credited because the payment is coming from the bank. That would have been the right posting. Now let's look at the error committed. They said it was entered on the receipt side of the cash book and credited to Ige's account. This is what we call complete reversal. Why is it called complete reversal? What is meant to be debited is credited, and what is meant to be credited is debited. Ige's account that is meant to be debited is credited, and then bank that is meant to be credited is what? That is meant to be credited is debited. So this is what we call error of complete reversal, and this error will not affect the trial balance. Why will it not affect the trial balance? Because on both sides, let's assume that 200 naira, or let's assume 200,000 is involved. The only thing that is affected here is the fact that this account is misposted. 200 will be on both sides, because what is debited is credited and what is credited is debited. The two amounts are involved, so they will cancel out. So it will not affect the total of the trial balance. All right, let's look at question 3. It says list 5 users of accounting information and state their respective interest in the accounting information. List 5 users of accounting information and state their respective interest in the accounting information. First of all, who is a user of accounting information? What do we mean by the word user of accounting information? A user of accounting information is somebody that is interested in the information generated by the financial statement. The essence of preparing financial statement is not just to ascertain the financial position of the company, but also to provide an avenue that will enable management to take decision. So, but there are a lot of parties, a lot of persons who are interested in that information. But the question is, why are they interested in the accounting information? And that is what is giving birth to this question. The examiner want to find out. He said, list 5 users. First of all, let's identify 5 different users of this information and state why they are interested in the information. We used to think that whatever we prepare is just within the, within the interest or within the consumption of the people within the organization. Maybe probably the management, employees, they want to see if they are doing well. But we have come to realize that outside these persons in the organization, there are other parties that are interested in the account we are preparing. So the examiner on this particular question want to find out if the student can remember 5. We have close to 10. You have close to 10, but they want to find out if the student can remember at least 5 users of accounting information and why they are interested in the information. Let me start with number 1. Number 1 is management or managers. The very first set of persons that are interested in accounting information, they are called management. Now, before then, let me give a breakdown. The users of accounting information are divided into 2. We have what we call internal users and external users. But in this question, the examiner did not expect the student to spell it out. So please, I encourage students not to go beyond the boundary of or beyond the expectation of this question. Some students will come and begin to prove that they have read so well. They will tell you, okay, users of accounting information are divided into 2, internal and external. You are wasting your time. The examiner is not expecting you to say they are internal. They say, just give me 5 users of accounting information. Now, number 1 is management. Number 1 is who? Management. Management or managers. Management are the set of persons employed in an organization to control the affairs of the organization. Now, these persons are the one in charge of planning, control, and execution of the policy of the business to achieve the target or the goal of the business. Now, they are interested in the financial information because they want to see if they've been able to achieve their targets. So why do they need the information? They need it to be able to know if the business is actually achieving its target. I said number 1, management. I said management will be interested in the accounting information because they want to find out if they've been able to achieve their targets. The essence of preparing the financial statement is to show if the business is making progress or the business is not making progress. And progress is actually measured in, is actually measured in the achievement of the target of every business have a target. Sometimes the target or the goal can be short-term. Some other times it can be long-term goal. So the financial statement is coming to show us whether we are really achieving whether short-term or long-term goals. So management, we want to find out if they are achieving their target. Then number 2 is the bankers, or what we call the financial institution. Number 2, that the second classes of users of accounting information is the bankers or the financial institution. Why do they need accounting information? They need accounting information to find out the credit worthiness of the business. There are some businesses that when you look at their financial statement, you cannot afford to lend them money. You know, we know bank as a financial institution that collect money from the public and also lend out money to the public. The money they are getting from the public, they loan it out also to the public. So for them to be very sure that this particular business is credit worthy enough, they need to understand or they need to know what is happening in the business. So they will want to find out, they want to get your financial statement. By the time they find your financial statement, they will know if you are credit worthy enough to be given loan. So I have said number 1 is management. They want to check if they will be able to achieve their target. Number 2 is bankers and financial institutions. They want to find out your credit worthiness. Number 3 is the owners, or what we call the shareholders, the people that own the business. You see, but nobody can just wake up one morning and just establish business, like that without an expectation. As long as it is a business, their target is to maximize profit. So the owners, or what we call the shareholders of the business, they need this information. They want to find out if you are making progress or you're not making progress. Now the progress is to a shareholder or the owner of the business is measured in profit. There is no other progress that is important to a shareholder or the owner of the business as much as profit. So it is on the financial information. It is in the financial information, accounting information, that the shareholder or the owner of the business will be able to know if they are making progress. So I said number 3 is the owners or the shareholders. And why do they need the accounting information? They need the accounting information to find out if the business is making profit or is making a loss. And then the 4th one is the set of persons we call the tax authorities. The tax authorities, they also want to find out your tax, or what we call tax payable. The government will want to come and take their own portion of the cake. You have succeeded in the business. They have some set of persons, they call them tax accountants for government, that will come into the organization and they will request to see what you are doing. So the accounting information provided for them will enable them to ascertain or will enable them to know the tax that is payable to the government. And then the 5th one is the employees. The employees, they also want to find out what is happening. As management is looking at the accounting information to find out if target is being met, the employees too, they want to find out. We are the one working. We are the one producing results. What is our level of stability? Because if you are working in an environment and you don't even know whether they are making progress or not, job security is at stake. There's nobody that will be working in a very good environment that will not always look out for job security. It is not a very good experience to be jumping from one company to another. So when you are working in an environment, you'll be interested in the accounting information. Why? Because you want to be very sure that this business is not going to collapse in the nearest future. If you are working and you don't have an idea whether the business is making progress or not, then your job security is at stake. But by the time you look at the accounting information and you can ascertain that, okay, with this information, I am sure that this business is making progress, then job security is guaranteed. So at that point, the employee, they want to know they need the accounting information to find out if the business is actually making progress so much that their job is secured. And then the sixth one is what we call the suppliers or the creditors. Now, what is the difference between the bankers or the financial institution and the supplier? Remember, I mentioned that bankers or the financial institution, they want to know if you are credit worthy. Now, in the case of a supplier or a creditor, these are the persons you have gone to buy items on credit from. You have gone to your supplier to buy on credit from them. So, what will they do? They will have to find out if you'll be able to pay your debt as at when due. There are some businesses that when they operate after some time, they won't be able to pay their debt. Especially when you have looked at your current asset, and your current asset is not enough to offset your current liability. There is a problem. There is a problem. So the liquidity ratio of a business is what will determine the stability of the business in the short run. So if the creditors or the suppliers look at your accounting information and they see that, guys, these people are not making progress, it will be difficult. They will know that this guy, they won't be able to meet up to the debt as at when due. Now, on their own part, they may begin to make provision for bad debt, because at some point they will know that you won't have the financial capability to meet up to your obligation. And then the seventh one is what we call the potential investors. There are some people that are interested in a business. They want to find out if the business is doing well so that they will know if they will invest into the business. Nobody can just wake up and then commit funds or invest into a business. Before you can invest into the business, you want to find out the viability of that business. Every business should be viable enough before you can commit your funds to it. So if you don't understand, or if you don't have the accounting information at your disposal, it will be very risky to commit funds into it. So the seventh one is the potential, what we call potential or prospective investors. These are the people that are interested in investing into the business. Now, we were asked to mention 5. I mentioned 7. Number 1, I said management. Number 2, I said bankers. Number 3, I said owners of the business. Number 4, I said tax authorities. Number 5, I said employees. Number 6, I said suppliers. And number 7, I said prospective investors. Now, let's quickly look at number 4. Let's look at question 4. They say question 4 says you should explain accounting ratio, giving one example of liquidity ratio. Let's start with what accounting ratio is. What is accounting ratio? Accounting ratio is simply quantitative relationship between two or more figures from financial statements. Quantitative relationship. Ratios expresses relationship between figures, expresses between a relationship between figures, between values on the financial statement. That's what ratio is all about. So they say you should explain ratio, giving one example of liquidity ratio. Now, having explained what ratio is, let's look at what liquidity ratio is. What is liquidity? Liquidity ratio is simply the ratio that looked into the current asset of a business in comparison to the current liabilities. What do I mean? Liquidity ratio look at the relationship between the current asset of a business and the current liabilities. It's looking at how the possibility of the business to convert their current assets into cash so they'll be able to meet up to their short-term liabilities. When you are going into a business, not every property at your disposal can last for 1 year. Some properties can last below 1 year. Some can last above 1 year. Now, when these properties cannot last for more than 1 year, they are called current assets. And then there are some other items of the business that can be easily converted into cash. Example, debtors, money that somebody is owing you. Anytime that money is gotten from that person, you've gotten cash already. And then another one is cash at bank. Your money that you have in the bank, you can easily go to the bank and then you get them. And then there's what we call bills receivable. Bills that you are expected to receive, even if you have not received them. And then what we call prepaid expenses. You have paid ahead of maybe a right. You've paid electricity. You're supposed to pay for 1 year, you paid for 2 years. These are the components of your current asset. Now, going to the current liability side, the current liability talks about obligations you are supposed to meet within 1 year. There are debts you are expected to pay or obligations you are supposed to meet within 1 year. Example, creditors, like we mentioned earlier, the people that you have gone to buy something on credit from. This set of persons, they may not allow you, they may not give you peace for more than 1 year. Of course, as you go to buy, you're expected to pay within a period so that them too can restock. So when you have this kind of obligation, liquidity ratio is actually looking at the relationship between what you have at hand and what you are expected to pay. Now, outside creditors, we also have what we call bank overdraft. When the bank permit you to withdraw beyond what is in your account. It's called bank overdraft. We also have what we call long-term loan, short-term loan, and then accrued expenses. There are expenses or right that you are owing to. So put all of them together force or constitute what we call current liability. So liquidity ratio will look at the possibility or the tendency of the business to convert their current assets into cash so they'll be able to pay their current liabilities. So let's look at it. Liquidity ratio, they say you should give one example of liquidity ratio. For liquidity, we have just two. We have what we call current ratio, or what we call working capital ratio, and what we call quick ratio, or we call it acid test ratio. So the two examples we have under liquidity ratio, they are number one, current ratio. Otherwise, you call it working capital ratio. This current ratio or working capital ratio is simply your current asset all over your current liabilities. If, for instance, you have let me assume you have 100,000 as your current asset, and then you have 50,000 as your current liability. What is your current ratio? Your current ratio is simply 100,000 all over 50,000. That is just to use 100,000 to divide by 50. It's going to give you 2. That is the way it is. So that is going to be your current ratio, or what we call working capital ratio. Working capital ratio. Then the second one is what we call quick ratio, or what we call acid test ratio. Now, the acid test ratio is your current asset. Your current asset minus stock divided by your current liabilities. Current asset minus stock divided by your current liabilities. Why do we need to subtract stock from your current asset, or what we call inventory? Why do we need to do that? We have to do that because we are looking at the asset that can be easily converted into cash. And you and I know that you can't predict exactly when your stock can be converted to cash. You have a stock of 500,000 in your warehouse. What is the possibility? At what point can you predict that this stock, we are going to empty our warehouse maybe in 1 week's time? It's not possible. So it's not really very easy to convert your stock into cash. That is why in quick acid test or quick ratio, we remove stock. So we will tell you we remove stock, so we want to know how much we can be able to realize from other classes of the current asset. So if you are asked, they said, explain accounting ratio, giving one example of liquidity ratio. I have said accounting ratio expresses relationship between values between figures, quantitative values on the financial statement. And I have given an example. I said one of the example of liquidity ratio is what we call current ratio, or we call working capital ratio. And then the second one is what we call quick ratio or axis test ratio. So state 3 users of accounting ratio. State 3 users of accounting ratio. We have state 3 users of accounting ratio. When we talk about users in this context, we are talking about the relevance of accounting ratio. The relevance of accounting ratio. Why do we need accounting ratio as a concept in accounting? Number one, it helps us to show what we call trend of a business activities over a period of time. What do I mean by trend? Trend is what we call consistency in accounting. What has happened in the business for some time, for a period of time. Now, trend analysis is simply comparing occurrences or comparing activities of a particular period with another period. So, accounting ratio will help us to determine what has happened in the business. So, we need accounting ratio because we want to know what happened in 2022, what happened in 2023, what will happen in 2024. If we can get a good knowledge of what happened in 2021, what happened in 2022, what happened in 2023, then we'll be able to predict what is going to happen in 2024. So the process of trying to understand what happened in 2021, 2022, and 2023 is what we call trend analysis. So the only thing that can actually help us to achieve this is the accounting ratio. Accounting ratio will show us the trend of activities over a period of time. Number two, there's what we call forecasting. I have already said that if you can understand trend, then you'll be able to forecast. You can be able to predict. Accounting ratio will help us to predict activities. Now, in 2021, we had a profit of, let me assume, 500,000. In 2022, we had a profit of 400,000. In 2023, we have a profit of 500,000. Now, 2022 was 500,000. 2023 was 400. 2021 was 500. 2022 was 400. 2023 is 500. You don't need anybody to tell you that in 2024, putting all other variables constant, the profit will be within 400 and 500,000. That's prediction. That's prediction. So with that now you can begin to forecast. If you want to make plans, you can begin to say, okay, since in 2021 we had 500, 2022 we have 400, 2023 we have 500. In 2024, the profit cannot drop beyond 400. So with that now you can forecast. You can now begin to plan in 2024. So the second uses of accounting ratio is that it will help us to forecast. And then the third one is what we call interfirm comparison. Interfirm comparison. Let's assume that we want to compare our outputs with company A. Or let's assume we are operating departmental store. If we are operating departmental store, this analysis accounting ratio will also help us. What is happening in department A? What is happening in department B? What is happening in department C? We can easily compare the results with this accounting ratio. Another thing is we can look at the financial statement of company A for 3 years and then compare it with company B, and then we take our decision. We have company A let me assume company A is a manufacturer. Let's assume a company that is in the same industry. Now, if we have a company that is in the same industry, we have company A, we have company B. When you look at their activities for 3 years look at the activities for 3 years, you can compare. So one of the uses of accounting ratio is that it will help us to do what we call intercompany or interfirm comparison. And then the fourth one is for interpreting the financial statement. It also helps us to interpret financial statement. Like I have mentioned, when you look at the current asset of a business and compare it with the current liabilities, you'll be able to know if the current asset is enough to foot the current liabilities of the business. These are just short-time predictions, or what we call the short-run prediction. So it will help us to interpret the strength of a business over a period of time. It can also help us to determine profit, the profitability of a business. The fifth one is that it will help us to determine the profitability of a business. If the profit is making progress, you can see it with the accounting ratios. If the business is not making profit, accounting ratio can also make us know that. And then the sixth one is to measure the ability of the business to meet up to his financial obligation. I have said this earlier. If you are able to understand the ratios, let's use the liquidity ratios that we have been talking about, the current asset and the current liabilities. First of all, you know that if you don't have enough current asset that can be converted into cash to offset your current liability, it will be difficult. It will be very, very difficult to meet up to your short-term liabilities. You have creditors to pay, you have overdraft to pay, you have outstanding electricity or outstanding expenses, you have bills payable, line up. And what you have maybe you have debtors, you have cash advance, now what is the possibility that this amount of money you are having at your disposal, or these items you have at your disposal, will be able to pay, or can be converted to cash to be able to pay this? Now somebody can ask me, why are we not talking about fixed asset? Are we not supposed to talk about fixed asset? The fixed asset, are they not still part of the company? They are. But the point is, if I have a tractor, let me assume I have a tractor that I want to sell, or I have plant and machinery that I want to sell. What is the time? How long will it take me to sell a tractor? How long will it take me to get somebody that can buy a machinery? Or how long will it take me to get somebody that can buy the furniture of the company? That is why when we are talking about analysis, current or liquidity analysis, liquidity ratios, we don't look at fixed assets. Because fixed asset, it will take a very long time to be able to get buyer. Somebody that can buy and then get the necessary cash to pay off your current liabilities. But for instance, debt, you can easily walk up to your debtor or call up your debtor and remind your debtor, say, please, we urgently need this money. And then you can take a legal actions against the debtor if the debtor refuses to pay as at when due. So that is why you see that debtors, cash at bank, the money you have at the bank, you just go to the bank to cash out. Or the one you have at home, what we call cash at hand. So that is why, in general, current asset is actually used to measure up with your current liabilities. And then, let's look at the C question 4C. Outline 3 limitations to the use of accounting ratio. Now, having looked at accounting ratio, having studied the importance, the need for accounting ratios, what are the limitations? What are the impediments? What are those things that can serve as a challenge when we are adopting accounting ratio? Number one, it deals in quantitative information only. Accounting ratio centered on figures. It's centered on figures only. That is a challenge. So any other thing that cannot be measured in figures cannot be used in accounting ratios. That is a challenge. You can't use the efficiency of management to measure to give an analysis on the financial statement, because it cannot be measured in figures. So the first limitation is that the information is measured in quantitative the informations are quantitative in nature. The second one is that it can be easily manipulated. Figures are the easiest set of information that can be manipulated. If you have 1 million here, just to remove 1 0, it will give you 100,000. That's how simple it is. So it can be easily manipulated. The third one are the use of different accounting policies and methods by firm make computing difficult. Different companies use different policies and different methods. Like for instance, company A can decide to say that our depreciation, the method of calculating depreciation is going to be straight line. While company B will tell you that what we are going to use is reduced balance method. Now, when you look at these two, one will charge depreciation at a very high rate from the beginning of the asset and a lesser depreciation towards the ending part of the asset. While the other one will charge equal depreciation all through. So you can see now the discrepancies in the policies and method. So these will impede the decision of the company. It will be difficult. So you have seen that it is a limitation already. And then the fourth one is that some firms window dress their financial statement, resulting in misleading information. What we mean by window dressing, they manipulate the information, manipulate the figures. And when these figures are manipulated, the information that will be generated will be what? Misleading. These persons that will be interested in this information, they may not have the exact information they need to be able to carry out what they intend to carry out. And then the fifth one is that it is not a good indicator for future planning because ratios are computed by past data. One of the fundamental challenge of accounting is what we call past information. Accounting is historical in nature. Events happen before they are recorded, and they can be manipulated. So it is not a very good indicator for future plan because these things happens before they are written down, and it can be distorted. So as long as the information, there are something that happened before they are written down, it can be manipulated. All right, so far we have looked at the 4 questions that are actually asked under section A of part B. Now, I have mentioned earlier that accounting questions in WAEC, they are divided into 2, objective and theory. While the theory is divided into part A and part B. Now, part A has 4 questions to answer 2, while part B has 5 questions to answer 3. Now, we've been able to explain the 4 questions under A. In our next video, we are going to look at the part B, the 5 questions that comprises the part B of the accounting question. I encourage that students should take time to look at these, thoroughly. And then when you want to answer accounting questions, don't be in a hurry to answer. Sometimes you can be efficient, but you're not effective. You will be so surprised to see that you have filled your paper with so much information, but when the result will come out, you can get a C. When you are asked a question, the emphasis of the examiner is not just on everything that you have read. Like this question we just look at now. They say outline. Anytime you see outline, what you need to do is just list or you mention. And as you mention, they say outline 3 limitations to the use of accounting information. Or as you mention, you can just put 3 sentences just to explain what you have outlined. That will give you your mark. But some people will, when they say outline, before you know, they will spend the whole time explaining what limitation is. They will spend the whole of their time trying to explain a particular, and before you realize time you have exhausted your time. So I encourage students to be very, very, very fair with their time and be very, very effective when they are managing their time.